Imagine a world where the financial ties between the United States and China suddenly snap. For decades, the US has been borrowing money, and China has been one of its biggest lenders, buying US Treasury bonds worth over $1 trillion at one point. But what if, one morning, China decided it has had enough? What if Beijing announces that it will no longer buy US debt, or worse, starts selling off the bonds it already owns? Would America collapse? Would China gain the upper hand in this global power struggle? Or is the reality more complicated than we think? Today, we are going to dive deep into this question and understand the consequences for the US, China, and the entire world economy. To understand the what if, we first need to understand the basics. The US government borrows money by issuing something called Treasury bonds, bills, or notes. Think of it like the government saying, "Lend us money now, and we'll pay you back later with interest." Investors, whether individuals, banks, or countries, buy these bonds because they are considered one of the safest investments in the world. Now, China, as a country, has been buying US debt for decades. But why? The answer lies in trade. China exports a massive amount of goods to the US. Electronics, clothes, machinery, almost everything you can imagine. In return, China earns US dollars. But holding trillions of dollars in cash doesn't make sense. So China invests this money in US Treasury bonds, which are safe, liquid, and give some return. In other words, buying US debt helps China recycle the dollars it earns from exports. At its peak, around 2011, China owned over $1.3 trillion in US debt, making it the single largest foreign holder of US treasuries. Today, that number has gone down to around $800 billion as China slowly reduces its holdings. To put this in perspective, the total US national debt is over $34 trillion in 2025, so China's share is big, but not the majority. Still, it's enough to make people nervous because if China suddenly pulls out, it could send shockwaves through the global economy. Let's first look at the milder scenario. Suppose China doesn't sell its current holdings, but simply stops buying new debt. What happens then? Well, the US government borrows money constantly to finance things like infrastructure, healthcare, defense, and even to pay interest on existing debt. If China steps back, the US will need to find other buyers. That could mean higher interest rates to attract investors, because if demand falls, the government has to make bonds more attractive. Higher interest rates would then ripple across the economy, making mortgages, car loans, and business loans more expensive. In the long term, this could slow down US economic growth. But the truth is, other countries and even US institutions like banks, pension funds, and the Federal Reserve would likely step in to fill the gap. So, while it might hurt, it wouldn't be a total collapse. Now, let's consider the scarier scenario. What if China suddenly decides to dump hundreds of billions of dollars worth of US treasuries onto the market? This could flood the market with supply, driving down bond prices and pushing up yields. In simple terms, interest rates in the US would skyrocket overnight. This could cause chaos. The US government would face much higher borrowing costs, American businesses would struggle to get cheap loans, and ordinary citizens would see higher mortgage and credit card rates. The US dollar might weaken as investors lose confidence, and global markets could panic. Stock markets around the world would likely crash, because if the safest asset in the world, US Treasuries, becomes unstable, everything else feels risky. Here's where it gets interesting. While this sounds like a financial nuclear option, it might actually hurt China as much as, or even more than, the US. Why? Because China holds those treasuries as investments. If it suddenly sells them in bulk, the value of those bonds would crash. That means China would take massive financial losses. It would be like burning your own money just to hurt your rival. Also, if the US economy crashes, China's economy suffers too. Remember, China's biggest export market is the US. If Americans suddenly stop buying iPhones, clothes, or electronics, China's factories take the hit. Millions of Chinese jobs depend on stable US consumer demand. So in reality, China has no real incentive to completely stop buying US debt or to dump it all at once. Even though a full-scale sell-off is unlikely, China could still use its US debt holdings as a strategic weapon. For example, in times of political tension, say, over Taiwan or trade wars, China could gradually reduce its purchases or hint at selling. Even such small moves could spook markets and create uncertainty, giving China some leverage. It's less about actually destroying the US economy and more about signaling power. On the flip side, the US knows this too, and that's why it has been trying to reduce its dependence on foreign buyers by encouraging domestic institutions to buy more treasuries. It's also why the US dollar remains the world's reserve currency, because despite all these risks, global investors still see it as the safest option compared to alternatives like the euro or the Chinese yuan. If China stops buying US debt or reduces its holdings drastically, the impact wouldn't just be on America. Countries around the world that rely on US bonds for their own financial stability would feel the shock. Global stock markets would fall, currencies would swing wildly, and international trade could slow down. In short, it wouldn't just be a US-China issue, it would be a global financial crisis. Some experts argue that China's slow reduction of US debt holdings is part of a long-term plan to de-dollarize the global economy. By buying gold, investing in African and Asian markets, and promoting the use of the Chinese yuan in international trade, China wants to reduce the world's reliance on the US dollar. If successful, this could reshape the global financial system over the next few decades. But this is a slow process, not an overnight event. So what if China stops buying US debt? The short answer, the US would face higher borrowing costs, the economy might slow down, and global markets would panic. But the long answer is more nuanced. China probably wouldn't take such a drastic step because it would also hurt itself. Both nations are locked in a kind of financial mutual dependence, where neither can afford to break free too suddenly. In the end, the real question isn't whether China will stop buying US debt tomorrow. The bigger question is, how long can the world's largest borrower and the world's largest creditor remain tied together without one side making a move that changes everything?